Have you ever wondered why the price of everything from your morning chai to your monthly electricity bill seems to be on a roller coaster? Or why news headlines are constantly buzzing about Pakistan, the IMF, and something called a review? Well, today, we're cutting through the jargon and breaking down exactly what's happening with Pakistan's economy. This isn't just about big numbers and complicated policies. It's about your wallet, your future, and the future of the country. We're going to explore the tough decisions being made, from new taxes to privatization, and see if they read the bitter medicine needed for a healthier economy or just another dose of hardship. We'll also demystify the IMF's role. Are they a helping hand or a tough taskmaster? By the end of this video, you'll have a clear picture of the monumental economic shifts underway in Pakistan. So grab a seat and let's get into it. First, let's talk about the big elephant in the room: the new budget and its policies. The government's primary mission is fiscal consolidation, which is a fancy way of saying they need to earn more and spend less to reduce the budget deficit. The main strategy? Expanding the tax net. For years, a huge part of Pakistan's economy has been informal, or undocumented. This means countless businesses and individuals operate without paying their fair share of taxes. The government is now getting aggressive, using data and technology to identify non-filers and bring them into the system. This isn't just about finding new taxpayers. It's also about increasing direct taxation on those who can afford it most. High-earning individuals and partnerships are seeing their tax rates go up. The idea is to shift the burden from indirect taxes, like sales tax on everyday goods which affects everyone, to direct taxes on income and wealth. Another major change is the revamped withholding tax regime. The government is broadening the scope of who is considered a withholding agent. This means more businesses will be required to deduct tax at the source whenever they make a payment, whether it's for services, supplies, or rent. It's a clever way to capture transactions that might otherwise slip through the cracks. But perhaps the most talked about policy is the new tax on retailers and traders. Instead of a complex filing process, the government is implementing a simplified fixed tax scheme for small and medium-sized shops. The goal is to make it easier for them to comply and contribute to the national exchequer, though it has faced significant resistance from trader associations. Now, what about spending? One area where we've seen some movement is the Petroleum Development Levy, or PDL. This is a tax you pay on every liter of petrol and diesel. While the government needs this revenue, it sometimes reduces the levy slightly to provide temporary relief at the pump, often as a political move to ease public pressure. At the same time, there's a major shift in subsidies. Blanket subsidies on energy and food, which benefit everyone regardless of their income, are being phased out. They're being replaced with targeted subsidies. The Benazir Income Support Program, or BISP, is a prime example. Instead of making electricity cheap for everyone, the government is giving direct cash support to the poorest households so they can afford their essential needs. It's a more efficient way to help those who are truly struggling. On the development side, we're seeing a significant increase in the Public Sector Development Program, or PSDP. This is the budget for big infrastructure projects, like roads, dams, and continuing work on the China-Pakistan Economic Corridor, or CPEC. The hope is that this spending will stimulate economic growth and create jobs. Conversely, the defense budget is under intense scrutiny. While it usually sees a nominal increase, there's growing pressure, both domestically and from international lenders, to rationalize military expenditures and find efficiencies. Another key area of reform is public sector enterprises, or PSEs. For decades, state-owned companies like Pakistan International Airlines and Pakistan Steel Mills have been bleeding money, costing taxpayers billions. The new budget allocates funds for their restructuring and, in many cases, privatization. The goal is to either make them profitable or sell them off to stop the financial drain. The reforms aren't just at the federal level. There's a strong push for provinces to step up and enhance their own revenue collection, particularly from sectors like agriculture and real estate, which have historically been undertaxed. To modernize the entire system, digitalization is being championed. We're seeing tax incentives for businesses and consumers who use digital payments and potential penalties for large cash transactions. This not only improves documentation but also makes the economy more efficient. Similarly, customs duties are being reformed to protect local industries from unfair competition, while also making it cheaper to import essential raw materials that those same industries need to function. Looking towards the future, there are proposals for a new contributory pension system for government employees. This would mean new hires contribute to their own retirement funds, easing the massive fiscal burden the current pension system places on the budget. And finally, to boost foreign exchange earnings, the government is offering tax breaks and subsidized energy to key export-oriented sectors like textiles and IT. Of course, all these reforms come with intense debate. The tension between the federal government and the provinces over resource sharing and who pays for what, known as fiscal federalism, is a constant theme in Pakistan's political landscape. Now, let's pivot to the issue that affects every single one of us directly: inflation. How is the government trying to control the skyrocketing cost of living? The primary tool is monetary policy. The State Bank of Pakistan has maintained a very high policy rate, or interest rate. By making it more expensive to borrow money, the central bank aims to cool down spending, or aggregate demand across the economy, which in turn should reduce inflationary pressure. Alongside this, there's been a focus on exchange rate stabilization. For a long time, the rupee's value was artificially managed. Now the policy is to let the market determine its value. While this can cause short-term pain and import-led inflation, the long-term goal is to curb speculation and build up foreign exchange reserves. But monetary policy takes time. For immediate relief, the government often resorts to administrative price controls, setting temporary price caps on essential items like wheat flour, sugar, and chicken. To make these controls effective, they also manage strategic food reserves. By building up buffer stocks of key commodities, the government can release them into the market during shortages to stabilize prices. You've likely seen this in action through the nationwide network of utility stores, which sell essential items at subsidized rates. To ensure these supplies aren't being hoarded or smuggled out of the country, there are frequent administrative crackdowns on profiteers. To increase the supply of essential goods, the government also temporarily reduces import duties on items like pulses and edible oil. On the energy front, tariff rationalization is a key strategy. This means creating different price tiers for electricity and gas. Lifeline consumers who use very little energy are protected with lower rates, while more affluent households and commercial users pay progressively higher prices. There's also a major push to promote indigenous energy sources. Developing local coal from tar, building more hydropower dams, and investing in solar and wind power are all crucial to reducing Pakistan's dependence on expensive imported fuels, which are a major driver of inflation. The government is also looking at the supply chain itself. By supporting local agriculture and small and medium-sized enterprises, the aim is to reduce the need for imported intermediate goods. You will also hear officials from the Finance Ministry and the Central Bank talking a lot about managing inflation expectations. Their communication is designed to convince the public and businesses that they have a credible plan to bring inflation down, preventing a cycle of panic-driven price hikes. And, as we mentioned earlier, the expansion of the Benazir Income Support Program is a critical part of the inflation control strategy, acting as a safety net to shield the most vulnerable from the worst impacts of rise in prices. So where does the IMF fit into all of this? Pakistan has been in and out of IMF programs for decades. The latest review is part of an ongoing standby arrangement. To get the next tranche or slice of the loan, Pakistan has to meet a strict checklist. This includes quantitative performance criteria, like hitting targets for foreign reserves and the fiscal deficit. It also includes structural benchmarks, which are specific policy actions like passing new tax laws or implementing power sector reforms. Often, there are prior actions, things that must be done before the IMF's board even meets, like a fuel price hike or an increase in electricity tariffs. The IMF's core demand is always fiscal consolidation. They want to see a clear, credible plan to reduce the budget deficit. They also require external financing assurances, meaning Pakistan must prove it has secured enough loans from friendly countries like Saudi Arabia, the UAE, and China, as well as other institutions like the World Bank, to cover its financing needs. A huge point of contention is the circular debt in the energy sector, a complex chain of debt that cripples the power and gas industries. The IMF insists on a concrete plan to contain and reduce this debt. Two non-negotiable principles for the IMF are a market-determined exchange rate and the autonomy of the state bank. They want to ensure the central bank can set interest rates without political interference. They also push for transparency in state-owned enterprises, demanding published financial reports and better governance. Broader themes like strengthening anti-corruption institutions and improving governance are also part of the conversation. More recently, The IMF has started encouraging spending on climate resilience projects. Ultimately, the goal of the review mission is to reach a staff-level agreement, which is the green light from the IMF team on the ground. This is then sent to the executive board in Washington for final approval and the release of the loan tranche. But even after this program ends, the story isn't over. Given Pakistan's high debt levels, the IMF will continue to conduct post-program monitoring, keeping a close eye on the country's economic policies. So there you have it. A deep dive into the complex world of Pakistan's economic reforms and its relationship with the IMF. It's a challenging path, filled with tough choices that have real-world consequences for over 240 million people. These policies, from taxes to subsidies to privatization, are all interconnected pieces of a giant puzzle. The hope is that these painful adjustments will lead to a more stable, sustainable, and prosperous economy in the long run. What are your thoughts on these reforms? Do you think they are the right steps for Pakistan? Let me know in the comments below. Thanks for watching, and if you found this video informative, please give it a thumbs up and subscribe for more content like this. See you next time.
Thanks for watching. Like, comments and share.